Alright guys, so we're going to put this difference between variable or direct costing versus absorption costing into practice through a worked example. So this worked example says a company begins the 2017 financial year with no inventory on hand. And that effectively means opening stock. In other words, when we look at our basic layout, the opening balance will be 0. Right, so no inventory on hand in the start. Okay, during the 2017 financial year, it manufactures 12,000 widgets and incurs manufacturing costs as follows. The variable manufacturing cost per unit is direct material 50 Rand per unit, direct labor 30 Rand per unit, variable manufacturing overheads 20 Rand per unit, and the fixed manufacturing overhead is 480,000 for 2017. Then it says, despite manufacturing 10,000 units, this should read 12,000 units. So despite manufacturing 12,000 units, the company sells only 7,000 at 190 during the year, and 5,000 are thus on hand at the end of the 2017 year. That makes sense. You start with 0, you produce 12, you sell 7, so you're left with 5. Okay. That's in the 2017 year, and then in the 2018 year, 9,000 widgets were produced, and 8,000 widgets were sold, also at 190. And then they said there was no price inflation in the 2018 year. So basically what that means is this 100 Rand didn't increase per unit, so it stayed 100 Rand per unit in 2018 as well, and this 480,000 didn't increase, it stayed 480,000 for 2018 as well. And then it says the normal production for the company is 10,000 units. So in other words, the budget, they expect to produce 10,000 units per year, but as you can see, in 2017 they produced 12,000, and in 2018 they produced 9,000. So in both years the actual differed from the budget. Alright, so let's quickly do the absorption costing income statement. So just to remind you what absorption costing income statement will look like, we have sales, and sales is effectively your selling price times your selling quantity. And that's the same whether you're doing absorption or variable, it doesn't change. So whether you're doing absorption or variable, sales is selling price times selling quantity. Okay, but just focusing on absorption costing for now. And in this video I'll just do the 2017 year. Our selling price is 190 Rand for 2017, and we're selling 7,000 units. So if you do that, 7,000 times 190 gives you the 1330. Okay, hopefully that's simple enough. Then our cost of sales, and just a reminder, our cost of sales is this little table over here, and cost of sales consists of opening balance, which is variable plus fixed. But in 2017 there's no opening stock, so that's why there's a 0 for opening inventory. Okay, our variable manufacturing cost for 2017 is 100 Rand per unit, and variable manufacturing cost gets multiplied with the number of units you produce. So if I take 100 Rand per unit and I produce 12,000 units, that means it's 100 times 12,000, that gives you the 1.2 million in the memo. Okay, remember under absorption costing I'm doing variable plus fixed. The variable part is the variable cost per unit, because variable cost changes with production. So variable cost per unit of 100 times by 12,000 units, and that gives me the 1.2 million, and the fixed cost was given to me of 480,000. Okay, so that's over there. Alright, now the important part, the closing stock. So just a reminder, closing stock will consist of variable and fixed. The variable part is easy because the variable part is 100 Rand per unit. The fixed part, however, we have to apply this formula, and because I'm focusing on, we have to apply this formula, and because I'm focusing on closing stock, it is essentially that formula, and it's the total fixed manufacturing cost of the current year divided by the higher of actual normal in the current year. Now the current year cost is 480,000. Actual production in the current year is 12,000. Normal production is 10,000. So if I have to take the 480 divided by the higher of actual or normal, the a hire of 12,000 or 10,000 is 12,000. Therefore, I'm going to say 480,000 divided by 12,000. And that's why you have this in the memo. 480 divided by 12,000. This gives you the fixed manufacturing overheads per unit. The variable manufacturing overheads is 100. And basically that gets added together. That I think that will come to 40 Rand. That's 100, so you effectively have 140. Variable fixed manufacturing overhead per unit is 40. Variable is 100, that gives you 140. Times by 5,000 gives you 700,000. If you work that out, cost of sales will be 980,000. Gross profit will be sales minus cost of sales of 350. There's no other cost to take off, and you end up with a net profit of 350,000. Alright, we'll end this video here for now. We'll come back with the 2018 year. Cool.